What is a tax way to invest in the stock market and protect capital gains to minimize them?
So generally speaking, we like to set up a partnership, put the trading into the partnership, and that partnership will be composed of a portion that goes to the individual, maybe 80, 90%, the rest to a C corporation. What does that do? Well, if we didn't do that and we had $100 of gains, normally that would all hit your 1040, 100% of it taxed on your 1040. But by putting it in a partnership, maybe let's call it a 90-10 split, $90 will only hit your return. $10, we've automatically had savings there. We kept it off the 1040. It would go to the C Corp. You might say, well, it'll still get taxed in the C Corp. Well, it would, but for that, it has all those reimbursements that we were talking about earlier, which you can use in the C Corporation, the accountable plan, all the office, the cell phone, everything until we was talking about mileage reimbursements, so on and so forth. Probably you're going to have more expenses to reimburse than what your 10% is. And because it's a partnership, we have a very special, unique payment called a guaranteed payment that you can pay to the partner, which would be your C Corp. That would get you more money into the C Corporation. It's going to allow you to get more money out of there tax-free to you, big deduction. And then that guaranteed payment, 90% of it would be a deduction on your personal return as well.
I was trying to write so that I could actually do this.
I always wondered how they did that.
What Elliot just described, this thing just doesn't want to do it. Oh, there it is. That's the weirdest thing. This thing does not like us today. Or you actually as an LLC tax as a partnership?
Yep. Correct.
What he just described is having the cash in that LLC where the brokerage account is held and having that corporation, what do you say, 20% or 10%?
Either one. Yep.
And that way, if money's made, it just automatically goes over there. But if I was talking about other ways, like, hey, what's the tax-wise way to invest in the stock market and protect capital gains? The best is always going to be a Roth IRA or a Roth 401k if you can get money in there, and then or an HSA. And then you never have to worry about paying tax. If it's the HSA and you use it for health, you never have to, you get a deduction and you never pay tax. If it's a Roth, you get you pay tax as it goes in. You're not getting a deduction for it, but then you never pay tax again. If you have expenses like Elliot just explained, you have very few options. Like you'd have to qualify as a trader in securities, which is really, really difficult to do. 750 trades a year, trading about 70% of the trading days, 4 hours a day, taking advantage of daily swings of the market. You got to be very, very active to qualify as a trader. Then you can write off your ordinary necessary business expenses, and then you get audited because you have zero income on a Schedule C, lots of expenses on a Schedule C, all your income sitting on a Schedule D, which to the accountants out there, they understand exactly what I'm talking about, but it's unusual, and the IRS likes to look at that and go, what the heck is this? And why are you trying to say that you're this thing called a trader? It does not exist in the Internal Revenue Code. It's a facts and circumstances test. We ignore it and just go right to that LLC Corp mix because there's frankly a lot more benefits to doing it that way. But still, there's folks out there that do the trader status. I get it. I'm just not a big fan. 24 years of doing this, seen too many mess ups, 25 years actually. It's just seen too many train wrecks for my taste. And so the best tax-wise way to invest in the stock market and protect capital gains is generally speaking going to be that structure or getting it into an exempt plan. Here's another fun one. If you want a big deduction towards the end of the year, like let's say you're looking at it right now going, hey, I know that I am service driven. I want to create something that's for my family, a foundation. Maybe it's, I want to do charitable work. Maybe I love, like you did Habitat for Humanity. Maybe I want to do affordable housing, and you want a big fat tax deduction. Take this, like take your appreciated stock where you have capital gains, long-term capital gains, transfer them directly into a donor advised fund or into a charity. 501c3, set up your own if you have to, but a donor advised fund for sure. Anderson has them, by the way. You just pop them in there. They don't cost anything. Pop it in there. You get a deduction on that fair market value of those shares, of those stocks. You get a big deduction, and then it's an exempt entity. You could trade like crazy inside that donor advised fund and make a ton of money, but it's going to go to charity. That's going to go to charity. But I love exempt organizations because you never pay tax. And in the case, like what's an exempt organization? IRA, 401k, 501c3, donor advised fund. They're all exempt. Those are the best places to, because you don't have to worry. You can just go nuts and make tons of money. You never have to pay tax. That's what the rich do. I mean, if everybody who ever wonders what the rich do, they get the money out of it. They don't own it themselves. They usually have it owned by something else that's exempt or has tax advantages. Or if they own it and it's growing and it's something that they can borrow against, then they live off of the tax-free income off of the loan, knowing that when they die, the basis steps up. If there's any sales to pay off that loan, it's 0% tax. That's what the rich do. But anyway, that's it for that.
If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.